The High Ticket Agent Blueprint Playbook, we're going to cover 5 advanced tax efficient life insurance strategies that Canadian agents are using to close $50,000 plus policies with Canadian business owners. So, this is specifically designed for Canadian life insurance agents and financial advisors who want to close high ticket life insurance cases. So, let's dive in. Here's what you'll learn. We're going to talk about why go high ticket. Then we're going to cover different strategies like the individual pension plan, referred to as IPP, the retirement compensation agreement, referred to as RCA, which is quite unpopular. We're going to cover the corporate owned life insurance, referred to as COLI, which is one of the most popular strategies. And we're going to cover split dollar critical illness insurance, as well as some leveraged strategies like IFAs and IRPs. So after that, we're going to be covering all of these different strategy in a comparison matrix so that you can see some side-by-side ROI analysis. Lastly, we're going to talk about a CRA compliance guide and some different talking points for CPAs and business owners that you're going to be presenting this to. Lastly, and most importantly, we're going to talk about how to get into high ticket life insurance cases today. So, why should you consider going high ticket? Well, there is a quiet revolution happening in the Canadian life insurance industry. There is a small group of agents that have discovered a market that most agents and advisors don't even know exists. So, that's a market where clients are actually motivated to buy. You're not chasing them. That's a market where commissions are 10 to 50 times larger than typical individual policies. It's a market where competition is almost non existent because most agents, like I said, don't know this market exists or they aren't trained to perform in this market. And lastly, it's a specific market where the sales process is more consultative compared to pushy. So the best part is you don't need any additional credentials, designations, or decade of experience. If you are licensed to sell life insurance in Canada, you already have everything it takes to get started. So let's talk about some simple math. Most agents are grinding through 100 plus sales a year, and they're averaging maybe $2,000 per policy. That's 200K in commission, but it comes at a brutal cost of having to work very long hours. We're talking 40 to 60-hour work weeks. We're talking constant need of prospecting and an endless treadmill of closing small cases. But what if you actually flipped the model? What if instead of going through the traditional approach, you went through the high ticket approach? Instead of closing 100 policies a year, you only have to close 10 or 20 policies a year. Instead of averaging $2,000 in commission, you average $25,000 to $100,000 in commission per case. Instead of having to work 40 to 60 hours, you only have to work 10 to 15 hours a week. Instead of chasing leads, you receive qualified appointments on your calendar. Instead of working with price sensitive buyers, you are working with value focused business owners and buyers. So, like I said, it's the same license, the same effort, but 5 to 10 times the income. And if you're thinking that this is too good to be true, it's just a theory, it doesn't exist, there are agents across Canada that are doing this right now with the same training and same licensing that you already have. So, why does this opportunity exist and why most agents miss it? Well, incorporated Canadian business owners that have 150 to $5 million plus in yearly profits after paying themselves have a massive problem. Taxes are destroying their wealth right now and in the future. So they face an impossible choice. They can either leave money in the corporation and be taxed at 50% on their passive income, or they can extract those profits personally and be taxed at 45 to 54%. So either way, nearly half of their hardworking money disappears to CRA. So these business owners are actively looking for solutions. They're not just price shopping, They're not comparing term quotes. They are asking, how do I keep more of what I've built and worked for? So, life insurance is the answer, but not the kind of life insurance that most agents sell. In this playbook, we're going to be covering 5 specific strategies that use permanent life insurance. One of them actually uses critical illness insurance to generate massive tax deductions up to $300,000 per year. We're going to be covering how to grow wealth tax free inside these policies. We're going to cover how to extract corporate funds to family with zero tax through the capital dividend account. We're going to cover how to provide living benefits like critical illness or disability. We're going to cover how to fund a succession and buy sell agreements. And we're going to cover how to create tax free retirement income for your clients. And by the way, these are CRA approved strategies, not loopholes. So they are written into the Income Tax Act. Accountants that know about them recommend them. Lawyers structure them into tax plans. And life insurance agents are very fortunate to be the ones who can understand, position them, and write them, therefore collect the commissions. So why would you do this right now? Well, the market is growing every year. There are more Canadians that are incorporating, more business owners that are hitting passive income thresholds that trigger punishing tax rates. And there are very few agents that are equipped to serve these business owners. So the agents who move first will own this market in their specific territory. The strategies by themselves aren't complicated. The products already exist, and the clients are already looking into them. So the only question is, will you be the agent they find? Now, let's move into the different strategies. Strategy number 1 is the individual pension plan, referred to as IPP. An IPP is a defined benefit pension plan for owner managers that allows significantly higher tax deductible contributions than RRSPs, specifically for those that are age 40 plus. So here's how it works. As far as tax deductions, 100% of the contribution is deductible for the corporation. When it comes to contribution room, it's between 50K to 150K per year, depending on the age and income of the business owner, versus a very small $31,560 RRSP max. For the growth, we're talking about tax deferred accumulation inside the plan. For the life insurance, the plan can hold up to 50% of contributions as a pension asset. And when it comes to retirement, it is taxed as pension income with splitting benefits. So who's the ideal client for this? Age 40 plus, because the contribution room is higher with age, a T4 income above $150,000. We're talking about incorporated professionals or business owners that are already maximizing their RRSP contribution every single year. We're talking about people with strong corporate cash flow and 10 plus years to retirement. So let's look at an example. Here we have a 50-year-old business owner that is going to have an annual IPP contribution of $75,000. So the tax save, let's say he's at 26.5% corp rate, is going to be $19,875 per year. So if you look at a 10-year total contribution of $750,000, which is really only $551,000 net to the business if you factor in the tax deductions. The projected value at 60 is going to be $970,000 plus a debt benefit of $1.5 to $2 million. Because of that, that business owner is going to be able to withdraw a 65, or not withdraw, but get a retirement income of 65 to 75K per year for life. So you've essentially turned 551,000 in net cost for the business into 2.5 to almost $3 million in total value. That's a 4.5 to 5.4x return for the business owner. Strategy number 2, retirement compensation arrangements. So an RCA is the unlimited retirement vehicle for executives who have already maxed out all their registered plans. It allows contributions far beyond the RRSP and the IPP limits. It is also the least popular and least attractive plan available in most cases. So here's how it works. There's a 50% refundable tax. So when the employer contributes $1 towards the plan, it must remit 50 cents to the CRA, which is held until the payout. So the good news is there's no contribution limit, unlike the RRSP. When it comes to the tax deduction, it is 100% deductible for the business, including the 50% tax to the CRA. Now, keep in mind that 50% tax is temporarily held until payout, so you get it back at payout. When it comes to life insurance, the RCA trust can own permanent life insurance. For retirement, it is taxed as regular income when withdrawn. And also, like I said, the CRA will refund the 50% tax that you've paid initially. So a lot of people have questions when it comes to that 50% tax mechanism. So here it is explained. When you contribute 300K to an RCA plan, 150K goes to the RCA trust for investment, and 150K goes to the CRA as a refundable tax. So when the distributions begin, the CRA refunds 50 cents for every $1 distributed. This effectively defers tax to retirement when the client may be in a lower tax bracket. So let's look at the ideal client profile. Some high income earners, 500K plus, maxing out their RRSPs and IPP space, who need retirement income beyond registered limits. We're talking about people with strong corporate profitability that are willing to accept a 50% refundable tax mechanism. So here's some key insight. At 75K a year contribution, the IPP outperforms the RCA. The RCA becomes more powerful at the 150 to 300K per year when the IPP limits are already exhausted. Let's look at strategy number 3, corporate owned life insurance. So COLI is the cornerstone strategy for Canadian business owners. The corporation basically owns permanent life insurance, and upon death, the proceeds flow through the capital dividend account, referred to as CDA, to their shareholders tax free. So let's talk about the capital dividend account, CDA. The CDA is a notional account that tracks tax-free surpluses. When the insurer dies, there's a specific formula. We're talking about CDA credit equals debt benefit minus the adjusted cost basis, ACB. So over time, the net cost of pure insurance, referred to as NCPI, reduces the adjusted cost basis towards zero, meaning eventually the full debt benefit becomes tax-free through the capital dividend account. Now, here's why corporate ownership wins. If you look at the tax rate on premium dollars, if it's corporate owned, it's only going to be 12 to 15% versus 45 to 54% through personal ownership. If you look at buying power advantage, it is 35 to 40% more affordable to buy with the corporation. And if you look at cash value growth, it is tax sheltered in both cases. The debt benefit to the family can be tax free via the capital dividend account or tax free directly if it's personal ownership. And business succession funding applies if it's corporate owned, but not if it is personally owned. So let's look at a case study extracting $1 million tax free. Without insurance, to extract $1 million from the corporation as a dividend, there would be around $477,000 in tax. So the family would receive more or less about $522,000 or $523,000. But with COLI, with corporate owned life insurance, if you look at $1 million in premium over a 10-year period, that creates a $3 million plus debt benefit. And the family is going to receive around $2.95 million via the capital dividend account with zero tax. So if you look at the leverage multiplier, It's basically 5.6x more efficient because you turned $1 million of corporate funds into $2.95 million in tax-free estate value. Let's look at strategy number 4, which is the split dollar critical illness insurance. So, a split dollar arrangement with critical illness coverage is a dual purpose planning at its finest. We're talking about living benefit protection plus tax advantage retirement saving. So, here's how it works: the ownership split is typically the corporation owns around 70%, which is also the debt benefit, and the individual owns around 30%, which is the cash value plus the critical illness benefit. So the premium split, each party is going to pay the premiums proportional to their ownership. When it comes to tax efficiency, because the corporation is funding the majority of the plan with pre-tax dollars, it's pretty tax efficient. And when it comes to the critical illness benefit, there's a tax-free lump sum to individuals if they are diagnosed with cancer, heart attack, stroke, etc. When it comes to the death benefit, it's going to flow into the corporation and then to the shareholders via the capital dividend account. So, an example, if you were to fund $50,000 a year for 10 years, your total premium is obviously 500K. The corporation is going to pay 70% of that, so 350K. The individual is going to pay 30% of that, 150K. And the cash value at age 60 is going to be more or less around $400,000 and around 500K in tax-free critical illness benefit, plus 1.5 million in death benefit that is going to be tax-free to the corporation, then via the CDA. So here's the key advantage. If the business owner is diagnosed with cancer, they will receive 500K tax-free to cover treatment, replace income, or supplement retirement, all while the death benefit and the cash value continues to keep building and increasing. Lastly, let's look at strategy number 5, which is leverage strategies, often referred to as IFAs or IRPs. So this is specifically for sophisticated, high net worth clients and business owners, typically 5 million plus in net worth, that can basically use leverage strategies to multiply their returns dramatically. So these are advanced techniques that require very careful implementation. Think about immediate financing arrangements, that's IFAs. It's basically a front-end leverage where the client purchases life insurance with large premium deposits and then immediately borrows from a bank using the policy as collateral. So for example, the client purchased permanent life insurance with a 100K plus deposit. The bank is going to go ahead and lend 90% of that cash value immediately. And then the client can invest the loan proceeds into business or real estate. Then deduct the loan interest from taxable income. So the net annual cost is only a fraction of the actual premium. Another one is insured retirement plan, so IRP, which is a back-end leverage for tax-free retirement income. So think about you overfund a permanent policy for 10 to 20 years, and then at retirement, the client stops paying the premiums. And the client start taking annual collateral loans against the policy cash value, which is obviously tax-free. So the interest capitalizes, so there's no out-of-pocket payments for the client, and the debt benefit repays the loan. So the remainder goes to the estate. So just a quick note here, you have to verify if the client can take annual collateral loans against the total policy value or just the cash value, okay? Now let's look at some comparisons here. COLI plus IFA versus RCA at the 300K per year comparison. So the annual funding is 300K with the RCA, 219K with the COLI plus IFA. The net corporate cash, 15 years, is going to be 3.285 million with the RCA versus only 1.170 million with the COLI. When it comes to annual retirement income, is going to be 300K taxable with RCA, or 100K tax-free with COLI plus IFA combination. The death benefit to the family with RCA is going to be zero versus 13.2 million tax-free with COLI plus IFA. So the total wealth delivered is going to be 6.1 million with RCA versus 15 million or 15.7 million with COLI. So the ROI with RCA is 1.87x versus 13x with COLI plus IFA. So typically, COLI plus IFA is going to deliver around 2.6 times more wealth with 64% less corporate cash required in this particular example. Now, let's look at strategy comparison matrix. If you look at the different strategies here on the left side, IPP, RCA, COLI, split dollars, CI, IFAs, and IRPs, the tax deferral here is explained. It explains who it's best for and some theoretical minimum contribution levels as well. Here you also can access in the ebook a quick decision framework for which product is or strategy is going to be best for which type of client, depending on their priority. You can also access a CRA compliance guide, which is very important to go over, and some different talking points that converts for accountants and business owners that might be interested in what you're doing there. So, in terms of next steps, how do you go from strategy to commission specifically? At this point, you understand the 5 advanced life insurance strategies that generate 25 to 100K in commission per client. But here's the truth. Most agents actually are going to learn this the hard way. But the strategy isn't the hard part. Finding qualified business owners who can implement these strategies is the hard part. So you can master IPPs, RCAs, COLI, IRPs, everything we've talked about, but none of it matters if you're still spending 40 hours a week chasing unqualified leads who ghost you, who can't afford the premiums, or don't have the tax problem that these strategies solve. So the real bottleneck is the fact that these strategies only work with a specific type of clients. Those are incorporated business owners that have 25K to 5 million in yearly distributable profits that are adding to their retained earnings. We're talking about business owners that are actively looking for solutions, and that's a very narrow slice of the market. So here's what top agents do differently. The agents that are closing $1 to $2 million per year in life insurance commissions aren't better at sales. They're not smarter than you either. They simply have a consistent flow of the right business owners on their calendar, and that's exactly where we come in. So we deliver 8 successful Zoom introductions per month with qualified and educated business owners who already understand the value of tax advantage insurance and are ready to have a real conversation with an agent or advisor. So this means that you can apply the strategies in this playbook immediately. You can get and start closing 1 to 2 clients each month at the 25 to 100K commission per case level, and you can enjoy the rewards of working with business owners. So we already have 35 agents across Canada that are actively enrolled in this program and are actively getting 8 qualified showed appointments per month from our company. So if you want results like Tanya, who increased her commission by $93,000 in 60 days of working with us, which completely transformed her business, or results like Anne, who increased her commission by $49,400 in 50 days of working with us, even though she had very little experience working with business owners. Or results like Sam and Sandra, who increased their commissions by an extra $144,000 within 7 months of working with us, despite being extremely busy agents. Or results like Sylvain, who increased his commission by an additional $108,000 in the first 6 months of working with us, even though he already had a super packed calendar. Or Dan, who closed a 50K additional commission in the span of 90 days, even though he had only been acquiring clients via referrals for the past 15 years. Or Thomas, who closed a huge incorporated dentist that paid him $250K in life insurance commission. If that's you and those are the results that you would like to have in your business, then go ahead and visit www.fundaco-media.com/playbook. You'll be able to watch our full service explanation video and book a 10-minute find out if we can help phone call with my team. That's it for this video. I hope you enjoyed, and I hope you'll be able to implement these strategies with some business owner clients in the near future. Cheers.